I'm not going to tell you whether to buy Bitcoin. I'm not going to predict where the price is headed next, and I'm definitely not going to give you financial advice. What I'm going to show you is what's actually happening behind the price right now, February 2026, and why it matters to how you think about your money. Because here's what most people missed. Bitcoin just dropped nearly 50% from its October peak of $126,000. It's now trading around $70,000. And the fear and greed index, the measure of market sentiment, is at 8 out of 100. That's extreme fear, the same level we saw during the 2022 bear market. But here's the thing. While everyone's watching the price, something much bigger is happening in the background. The institutions, the BlackRocks, the JPMorgans, the Wells Fargos, they're not leaving. They're restructuring how they think about this asset. Let me show you what I mean. Bitcoin's market cap still sits above $1.3 trillion. That makes it larger than most companies in the S&P 500. It commands 56% of the entire cryptocurrency market, more than half. Yet the US Bitcoin ETFs, those funds that bought 46,000 Bitcoin this time last year, are now net sellers in 2026, according to CryptoQuant data from early February. Over the past 10 days, net flows dropped by about 18,000 BTC. That's $360 million in outflows just this week. Most people think that's purely bearish, but look deeper. BlackRock's IBIT, the world's largest Bitcoin ETF, holds $54 billion in assets as of February 10th. That's 786,000 Bitcoin in custody. During one session on February 5th, when Bitcoin fell 13%, IBIT recorded nearly $10 billion in trading volume. $10 billion in one day. Bloomberg ETF analyst Eric Balchunas pointed out something interesting. If IBIT can attract $25 billion in a weaker year, the upside during a stronger market could be significantly larger. In other words, the infrastructure is being stress tested right now, and it's holding. But wait, there's a second force at work here that explains why institutions are behaving this way. The Federal Reserve held interest rates steady at 3.5% to 3.75% in January. Chair Jerome Powell said the Fed sees clear improvement in the outlook for growth and evidence of stabilization in labor markets. Markets now expect just 2 rate cuts in 2026, one in June, one in September. CME Group's FedWatch tool shows 83% odds for that June cut. Here's why that matters for Bitcoin. When rates stay higher for longer, the opportunity cost of holding non-yielding assets like Bitcoin increases. Cash in a money market fund might earn you 4.5%. Bitcoin pays 0. That creates pressure. But, and this is the pivot most people missed, inflation just came in at 2.4% annually for January, according to the Bureau of Labor Statistics data released February 13th. Core CPI hit 2.5%, the lowest level since April 2021. That's right where economists expected it. Heather Long, chief economist at Navy Federal Credit Union, said, "This is great news on inflation. Inflation fell to the lowest level since May, and key items such as food, gas, and rent are cooling off. If inflation keeps cooling, those rate cuts become more likely." And here's the counterintuitive part. Even as the US dollar index fell 9.21% over the last 12 months, which historically helps Bitcoin, Bitcoin still declined. That tells you something important. Bitcoin isn't just trading on dollar strength anymore, it's trading on institutional risk appetite. And right now, institutions are cautious, which brings us to what the smart money is actually doing. Let's talk about MicroStrategy, now rebranded as just Strategy. The company bought 1,142 Bitcoin last week for $90 million. Average price, $78,815 each, according to data published by the company on February 9th. Here's what makes that interesting. That purchase happened right before Bitcoin dropped to $60,000. Strategy now holds 714,744 Bitcoin, purchased for a total of $54.35 billion. Their average cost, $76,056 per coin. With Bitcoin around $70,000, that means the world's most aggressive institutional Bitcoin buyer is roughly break even after 5.5 years of continuous accumulation. But there's a problem emerging. From January 5th to January 26th, Strategy's diluted share count rose 5.36%, while Bitcoin holdings increased 5.77%. The gap is narrowing. Each new share issued to buy more Bitcoin gives existing shareholders slightly less Bitcoin per share. The company is still accumulating, but the model is losing efficiency. For personal finance audiences, here's why that matters. Even the most committed institutional buyer faces real constraints when prices fall and their cost of capital rises. Now contrast that with what traditional banks are doing. Wells Fargo, JPMorgan, and BNY Mellon have all launched lending desks that accept Bitcoin ETF shares as collateral for US dollar loans. Read that again. You can now borrow against Bitcoin ETFs with the same ease as borrowing against your stock portfolio. That's not speculation. That's infrastructure. That signals Bitcoin is being treated as a Tier 1 asset by major financial institutions. So we have two stories happening at once. Prices falling, sentiment at extreme fear, ETF outflows mounting, but banks quietly integrating Bitcoin into their lending operations like it's just another asset class. Which one matters more? That depends on your time horizon. Let me give you more context on what's really driving institutional behavior right now, because this gets to the heart of why Bitcoin is where it is. From November 2025 through January 2026, the spot Bitcoin ETF complex as a whole shed about $618 billion in net capital. That's the longest sustained outflow streak since these vehicles launched. When redemptions of that size force sponsors to sell spot Bitcoin into a falling market, you get a feedback loop. Selling pushes price lower, lower prices trigger more risk management selling by ETF holders, and funds like IBIT sit in the middle as both the largest holder and the largest source of incremental supply. The volatility during the February price drop reached extremes. On February 5th, BlackRock's IBIT recorded nearly $10 billion in trading volume in a single session. The same day, Bitcoin fell close to 13%. IBIT alone recorded outflows of more than $370 million that day. Options trading on the fund surged to a record 2.33 million contracts and $900 million in premiums. Some analysts, including one named Parker, attributed the record options activity and heavy selling to a leveraged hedge fund blow-up that dumped IBIT shares amid margin calls, intensifying the crash. This reveals something crucial about how Bitcoin trades in 2026. It's no longer just retail speculation. It's institutional position management, risk limits, and margin calls playing out in real time through regulated ETF wrappers. That creates different dynamics than the pure crypto-native trading that dominated previous cycles. Let's hear from people with real skin in the game. James Butterfill, head of research at CoinShares, told CNBC on February 5th that $70,000 is shaping up as a key psychological level, adding that if we fail to hold it, a move toward the $60,000 to $65,000 range becomes quite likely. Bitcoin briefly hit $60,060 on Thursday evening before recovering above $70,000 by the weekend. On the macro side, Federal Reserve Governor Stephen Moran said in a recent speech that rates may be tighter than necessary. He argued, "The biggest risk is that we're misconstruing just how tight monetary policy is," and called for further rate cuts. He added, "I have a hard time being concerned about inflation." If Moran's view gains traction and the Fed cuts more aggressively, Bitcoin would likely benefit from increased liquidity. But right now, that's not the consensus view. Bernard Yaros, lead economist at Oxford Economics, wrote, "The downside surprise in the January CPI is welcome news for the Federal Reserve, but we aren't changing the baseline forecast for monetary policy based on one inflation reading. Notice the tension here. You have Fed officials debating whether policy is too tight, economists saying one inflation report doesn't change the path, and markets pricing in just two cuts all year. That uncertainty creates the volatility we're seeing. And here's the thing about volatility. It's not a sign Bitcoin is broken. It's a sign we're in genuine price discovery. No one knows the right valuation for this asset yet, and that includes the institutions with billions deployed. Now let me show you what's happening at the political and regulatory level, because this shapes whether institutions feel comfortable allocating more capital or pulling back. The Trump administration has signaled crypto-friendly intentions, but Trump's tariffs are running in the background when it comes to inflation. Fed economists generally see the duties as adding near-term pressures that will abate later this year. This creates a complex backdrop where pro-crypto political sentiment must compete with economic realities that constrain the Fed's ability to ease policy and therefore Bitcoin's ability to benefit from loose monetary conditions. Markets are waiting for President Trump to announce his nomination for the next Federal Reserve chair. Treasury Secretary Scott Bessent told Yahoo Finance that his inclination is we may hear something in the next week or so. President Trump said last week in Davos that he intends to announce the next Fed chair very soon. Trump's selection of Kevin Warsh comes after months of deliberation and after the central bank paused its easing of monetary policy. Warsh has been critical of the Fed in recent months, but is seen as a conventional choice for the role. Warsh served as Fed governor during the financial crisis from 2006 until 2011. Although he's considered a relatively safe pick, Warsh faces an uncertain path in the Senate due to potential Republican opposition. For personal finance audiences, the regulatory question isn't about specific SEC enforcement actions or commodity definitions. It's simpler. Will institutions feel comfortable allocating client capital to Bitcoin, and will traditional financial infrastructure fully embrace crypto assets? The defining structural shift of 2026 is the reclassification of Bitcoin as a functional Tier 1 asset. When major banks allow clients to borrow against Bitcoin ETFs with the same ease as borrowing against stock portfolios, Bitcoin moves from speculative fringe to portfolio building block. The regulatory infrastructure enabling this shift happened quietly through 2025 and early 2026, creating plumbing that will outlast any single administration's rhetoric. Beyond price and sentiment, we can look at the blockchain itself. the immutable record of who's moving Bitcoin and where. Bitcoin broke below its 365-day moving average for the first time since March 2022. According to CryptoQuant data published in early February, it's declined 23% in the 83 days since that breakdown. That moving average matters because it tells you the average price paid by everyone who bought Bitcoin over the past year. When price breaks below that level, it means the average holder is underwater. That creates pressure. The MVRV ratio, think of it as Bitcoin's price-to-book value, compares market price to the average acquisition cost across all coins. Historically, values above 3.7 indicated price tops. Values below 1.0 indicated undervaluation. While specific current figures weren't available, the framework helps you understand that Bitcoin markets exhibit mathematical patterns, not just random chaos. On-chain data also shows more than $2 billion in leveraged positions were liquidated during the week of February 5th, according to CoinGlass. These liquidations happen when traders using borrowed money can't meet margin requirements. Exchanges forcibly close their positions, selling into falling markets, amplifying the drop. For those unfamiliar with crypto's 24/7 leverage culture, these liquidation cascades represent a structural difference from stock markets. There are no circuit breakers, no trading halts, no stabilization mechanisms calibrated over decades. That creates extraordinary volatility, which punishes speculation but creates opportunities for patient capital. The Fear and Greed Index captures something real about network activity. Its extreme fear reading incorporates volatility, market momentum, social media sentiment, surveys, Bitcoin dominance, and Google Trends data. When sentiment reaches these levels, retail interest has typically collapsed and speculative positioning has unwound. Now I want to walk you through what might happen next, not as predictions, but as scenarios worth understanding as you think about your broader financial picture. If inflation continues cooling and the Fed delivers the 2 rate cuts markets currently expect in mid to late 2026, liquidity conditions could improve substantially by the third and fourth quarters. The lower than expected inflation reading helped boost the outlook for Federal Reserve interest rate cuts in the futures market. Traders raised the odds for a reduction in June to about 83%, according to CME Group's FedWatch tool. Under this scenario, Bitcoin could revisit the $90,000 to $100,000 range as institutional flows reverse and retail sentiment improves. The massive infrastructure built through 2024 and 2025, spot ETFs, bank custody, lending facilities, would rapidly reabsorb capital once conditions turn supportive. Eric Balchunas noted that if the fund can attract $25 billion in a weaker year, the upside during a stronger market could be significantly larger. Alternatively, Bitcoin could trade in a wide range between $60,000 and $80,000 for an extended period, frustrating bulls and bears alike. This would resemble the 2019 consolidation that followed the 2018 bear market, where Bitcoin needed time to rebuild conviction before the 2020-2021 bull run. James Butterfield's observation that $70,000 is shaping up as a key psychological level suggests the market is finding its footing. If Bitcoin holds this range and institutions use weakness to accumulate slowly, the asset could build a firmer foundation than the rapid 2024-2025 run-up provided. Or consider a deeper correction scenario. If global growth weakens, the Fed proves unable to cut rates due to persistent inflation, or a credit event forces institutions to reduce risk across all asset classes, Bitcoin could revisit the $50,000 to $55,000 range. This would represent a roughly 60% decline from the October 2025 peak, painful but not unprecedented in Bitcoin's history. IBIT's performance shows total return over 6 months around negative 28.5% and roughly negative 20.5% over the past year, the profile of a product with close to 1.0 correlation to Bitcoin in a market that has shifted from euphoria to forced selling. There's also the macro surprise scenario. Policy surprises could dramatically shift Bitcoin's trajectory in either direction. Governor Miran's view that rates may be tighter than necessary, and his call for further rate cuts could gain traction if labor markets weaken. Alternatively, an inflation resurgence could force the Fed to raise rates again, creating severe headwinds for all risk assets. Trump's tariffs running in the background add near-term inflation pressures, creating policy uncertainty that could cut either way, supporting Bitcoin as a hedge against political risk or pressuring it as a risk asset sensitive to growth concerns. The point of walking through these scenarios isn't to predict which one happens. It's to show you that Bitcoin's path depends on forces that are knowable and trackable. Fed policy, inflation data, institutional risk appetite, regulatory clarity, and on-chain supply dynamics. This isn't magic or mysticism. It's an asset responding to the same macro pressures that move stocks, bonds, and real estate, just with significantly higher volatility. So what does all this mean for your financial strategy? I'm not going to tell you to buy or not buy Bitcoin. That depends entirely on your situation, your risk tolerance, time horizon, and what you're trying to achieve with your money. But here are the questions you should be asking yourself. First, can you tolerate a 50% drawdown? Because Bitcoin just did that in 4 months. If that kind of volatility would make you sell in panic or lose sleep, your allocation should be minimal or zero, regardless of long-term thesis. The emotional toll of volatility destroys more wealth than bear markets. Second, what role would Bitcoin play in your portfolio? BlackRock ranked its Bitcoin ETF among its 3 biggest investment themes for 2025, alongside treasury bills and mega-cap tech stocks. The world's largest asset manager considers Bitcoin worthy of top 3 thematic status. But some Bitcoin and a lot of Bitcoin are vastly different risk profiles. If you view Bitcoin as portfolio insurance against monetary debasement, a small allocation that might protect against catastrophic fiat currency outcomes, that typically represents 1 to 3% of portfolio value. If you see it as a growth asset that could appreciate substantially over decades, allocations might run 5 to 10%. Anything beyond that enters speculation territory where permanent loss of capital becomes a likely outcome. Third, do you have the infrastructure to own this safely? You can buy BlackRock's IBIT in a standard brokerage account with the same ease as buying a stock ETF. Coinbase custodies the Bitcoin. You don't have to worry about private keys or hardware wallets or becoming a target for physical theft. Direct Bitcoin ownership, holding private keys and hardware wallets, offers maximum sovereignty, but introduces custody risk most personal finance investors aren't equipped to manage. Self-custody advocates claim not your keys, not your coins. But counterparty risk through regulated custodians like Coinbase seems substantially lower than the risk of losing hardware wallet seed phrases or falling victim to physical theft. And here's the final question, the one that matters most. What does Bitcoin mean in a world where inflation is cooling toward the Fed's 2% target, rates are stable, and growth continues? The original Bitcoin thesis emphasized protection against currency debasement and government overreach. But if the macro environment normalizes, inflation near target, rates steady, growth modest, does Bitcoin still command premium valuations? Or does it just become another risk asset competing for capital against stocks, real estate, and credit? The institutional infrastructure now embedded in the financial system suggests Bitcoin has staying power beyond any single macro regime. Wells Fargo, JPMorgan, and BNY Mellon don't build lending desks for assets they think will disappear. But Bitcoin's risk-reward profile in a normalized environment likely differs from its profile during zero-rate emergency policy. When the Fed was printing trillions and real interest rates were deeply negative, Bitcoin's appeal as a scarce digital asset was straightforward. In an environment where cash yields 4.5% and the Fed is running restrictive policy, Bitcoin has to compete on different terms. That doesn't make Bitcoin uninvestable. It changes what you should expect from it. Instead of explosive appreciation driven by monetary expansion, you might see slower, more volatile accumulation driven by institutional adoption, regulatory clarity, and technological maturation. Instead of a pure monetary hedge, you might see Bitcoin functioning more like a high beta tech adjacent asset that amplifies market moves in both directions. Here's what we know for certain. Bitcoin trades around $70,000. The Fear and Greed Index sits at 8. ETFs show $360 million in outflows this week. The Fed holds rates at 3.5% to 3.75%. Inflation cooled to 2.4% annually. These facts describe Bitcoin's current position. They don't predict its future. What they reveal is an asset undergoing genuine price discovery after a massive rally and correction, with institutions still present but cautious, macro conditions moderating but uncertain, and infrastructure continuing to build despite volatility. Bitcoin represents neither salvation nor scam. It represents an emerging asset class undergoing the messy, volatile process of integration into global financial markets. Some investors will profit enormously from this process. Others will lose substantially. Most will experience volatility that tests their conviction. The questions you ask yourself matter more than any analyst forecast. Your financial situation, your risk capacity, your time horizon, and your emotional relationship with volatility will determine whether Bitcoin deserves a place in your portfolio, and if so, how much. If this kind of behind-the-scenes breakdown is useful to your financial thinking, if you value having someone do this research for you and translate it into plain English every week, hitting subscribe means you won't miss the next one. No hype, no predictions, just data, context, and the questions worth asking. I'll see you in the next one.